Well, let's bring in our first guest of the hour on how he's talking to clients and perhaps adjusting portfolios in reaction to the tariff threat. Colin Stewart joins us. He's a familiar face to viewers of this program. He's also CEO and portfolio manager at J.C. Clark. Colin, thanks a lot for coming in.
Good to be here, Paul.
We chatted just briefly before coming on air. How have you been speaking to your clients and have you made any portfolio changes leading up to today?
Yeah, obviously we've tried to reassure clients. I think we've been proactive about it, not only talking to our clients about the tariff risk, but I think, for several months now we've been reviewing different investments, thinking about what kind of businesses we want to own in Canada, which ones we may not want to own, and trying to really insulate our portfolios from any significant direct tariff risk. And we think we're in a pretty good sort of relatively defensive position today.
What kind of stocks do you not want to own in this environment?
Yeah, I mean, I think primarily would be highly cyclical businesses in Canada, or businesses that manufacture a lot of products here and ship those across the border. Things like, there are some industrial companies, obviously a business like, Winpack comes to mind as one that's highly exposed. I think a lot of the auto parts makers like Linamar Magna, we see their stocks have been weak. Companies that have significant manufacturing in Canada or Mexico and ship those products to the U.S. So I think we do own some businesses with U.S. revenue, but largely they have facilities, personnel in the U.S., and they supply domestically for those customers. So I think those businesses are much more protected.
What are your views on things like the Canadian banks? The Canadian bank stocks are all down pretty sharply today. They're among the most influential decliners in today's trade.
Yeah, I don't think the Canadian banks necessarily have a lot of direct exposure. It's that idea of indirect exposure if the Canadian economy weakens a lot and unemployment were to go up, for example. So I think really that's the reaction we're seeing today. And perhaps some of the more domestically focused banks would have the most exposure to, CIBC might come to mind with, a lot of domestic exposure to the mortgage market here. Businesses like BMO and TD maybe have a little bit more U.S. exposure, so might benefit, for example, if the U.S. economy outpaces the Canadian economy. But I think the reaction in Canadian banks is really just more broadly the idea that the Canadian economy could weaken because of this tariff war or trade war. And if that increases unemployment, could increase loan losses, et cetera, et cetera.
There are Canadian economists, leading Canadian economists, who do predict that if the tariffs last for a year or so, that the Canadian economy, they believe, will be pushed into recession. Doug Porter at BMO is one of those. Douglas Barrett at Desjardins is another. Do you accept that call? Do you agree with that call?
Yeah, absolutely. I mean, I think even if the tariffs were to last 6 or 9 months, it would be a very negative situation for the Canadian economy. I guess the question really is, will that happen? And I think what people have been overlooking up until really the last week or so is that this trade war is also going to be very negative for the U.S. consumer. We've already seen companies come out this morning in the U.S. Target, Best Buy suggest that they're going to have to increase prices on product. That's going to directly negatively impact the U.S. consumer. We're seeing U.S. consumer confidence roll over, inflation expectations rise. So really the exact opposite of what the Trump administration's stated mandate was to do. Yeah. You're seeing things move the wrong direction. So I think a lot of it is going to come down to how much patience do they have for playing the long game here, and will he make a rash decision to reverse some of this if he sees the stock market continue to sell off, or if he sees the economy and economic sentiment continue to weaken.
Over what period of time do you think we might see U.S. economic indicators react in a big way here? How much of a period would be before we see U.S. CPI uptick significantly, for instance?
Yeah, I think it could be a matter of months. I mean, frankly, just in the last couple of months, we've already seen, as I said, consumer confidence weakening significantly, inflation expectations really spiking up. So the stock market reacting, and I think even, if you just take it down to a more granular level, you're already hearing CEOs and boards talk about maybe deferring CapEx decisions, deferring hiring decisions. So when there's a high level of uncertainty as we have today and nobody knows exactly what's going to happen, I think many business leaders tend to be cautious and hold off on big projects or big new acquisitions. And I think we're already seeing that. We haven't seen a ton of M&A so far this year. Right. Haven't seen very many IPOs. And I think it's for exactly the reason that I said.
Okay, let's go to a couple of stocks you like. And I would assume, of course, that you like them in this tense economic environment. One is Premium Brands, ticker symbol PBH on the TSX.
Yeah, a very high quality quality, pretty defensive business. They're a large North American, really food manufacturer distribution business. They do a lot of private label work for companies like Starbucks, which would be their biggest customer, for example, producing food products that are sold. They've got a lot of facilities in the U.S. where they do a ton of business, so there's not a really direct impact from the trade side. And because it is a food consumer staple type business, we think it's relatively, non-cyclical or not economically sensitive. It pays a very nice dividend of 4%. And they've also been spending a lot of money to grow their business in the U.S. by building new facilities, but they haven't filled those up yet to see the real benefit on the cash flow statement. And we're going to see that happen over the next 12 or 18 months as they fill those up with orders and business they've already signed. You're going to see the cash flow, EBITDA of that business go up significantly. So, and the valuation's pretty attractive too. It's sort of at the very low end of where it's traded in the last decade.
Okay, we have a very short amount of time for Dental Corporation. It's an acquirer of dental clinics.
Yeah, largest acquirer of dental clinics in Canada. They have about 550 clinics. It's a purely Canadian business, very stable. People go to the dentist. Valuation is reasonable, large opportunity to continue consolidating, and the kind of business that we think people should own in this type of environment.
Colin, thanks for joining us on a busy day.
Great to be here.
Colin Stewart is CEO and Portfolio Manager at JC